you do not notice it happening. There is no single day where your grocery bill suddenly doubles. It creeps. A few cents here, a dollar there. 6 months later, you are paying $40 for what used to cost 30, and you cannot point to the exact moment it happened. That is inflation. But here is what the news never actually tells you. Inflation is not one thing. There are at least 12 different kinds, different causes, different consequences. And knowing which one is actually happening tells you exactly what is coming next. Here is every kind of inflation, what causes it, and what it actually feels like when you are living inside it. Demand pull inflation. This is the inflation you learned about first, even if nobody called it by name. Demand pull inflation happens when demand for goods and services grows faster than the economy's ability to supply them. Too much money chasing too few goods. Picture a popular new product with limited stock. More people want it than there are units available. Sellers raise the price because they can. Demand pull inflation happens at an economy-wide scale when this dynamic plays out across many industries simultaneously. Strong employment, rising wages, government stimulus, low interest rates encouraging borrowing and spending. All of it can push demand higher faster than businesses can expand supply to match. The result is prices rising across the board, not because anything got more expensive to produce, but because more people are willing and able to pay more for the same thing. Cost push inflation. This is the inflation that starts on the supply side, not the demand side. Cost push inflation happens when the cost of producing goods and services rises, and businesses pass that cost on to consumers through higher prices. Raw material costs increase, labor costs increase, energy costs increase. A supply chain disruption makes a critical component scarce and expensive. Businesses face a choice: absorb the higher cost and accept lower profit margins, or raise prices to protect their margins. Most businesses, most of the time, choose to raise prices, at least partially. The key distinction from demand pull inflation is where the pressure originates. Demand pull starts with people wanting to spend more. Cost push starts with businesses needing to charge more just to maintain the same profitability they had before. Both result in higher prices. The underlying mechanism driving them is completely different. Built-in inflation. This is the inflation that feeds itself. Built-in inflation, sometimes called a wage price spiral, occurs when rising prices lead workers to demand higher wages to maintain their standard of living. And those higher wages then increase business costs, which businesses respond to by raising prices further, which then leads to demands for even higher wages. A self-reinforcing loop with no natural stopping point built into the mechanism itself. Once this cycle gets established, it becomes genuinely difficult to break. Workers are not wrong to want wages that keep pace with rising costs. Businesses are not wrong to raise prices when their own costs have genuinely increased. Each individual decision in the cycle is rational. The collective result is inflation that continues independent of the original cause that started it, running on the momentum of expectations alone. Core inflation. This is the number economists actually watch, even though it is not the number that dominates headlines. Core inflation measures price changes while excluding food and energy prices, specifically because those categories are notoriously volatile, swinging significantly due to seasonal factors, weather events, and geopolitical disruptions that have little to do with the broader underlying trend in the economy. By stripping out that volatility, core inflation is intended to reveal the more stable, persistent trend in price growth, the signal underneath the short-term noise. Central banks rely heavily on core inflation when making decisions about interest rates, because reacting to temporary spikes in gas or grocery prices could lead to policy mistakes based on noise rather than genuine economic trends. The trade-off is that core inflation can feel disconnected from lived experience, since food and energy are exactly the categories most people notice and feel most immediately in daily life. Headline inflation. This is the number you actually see in news reports. Headline inflation measures the total change in prices across the entire basket of goods and services tracked by economic statisticians, including the food and energy prices that core inflation deliberately excludes. Headline inflation represents the complete picture, what people are genuinely experiencing in their total cost of living. The downside is that headline inflation can be significantly more volatile month to month, swinging based on events like an oil price spike or a poor agricultural harvest, even when the broader, more persistent economic trend remains relatively stable. When you hear two different inflation numbers reported in the same news cycle, one is almost always headline and one is almost always core. Understanding which one you are looking at changes how you should interpret what it means for your own financial situation. Hyperinflation. This is the inflation that stops being an economic statistic and becomes an economic catastrophe. Hyperinflation is extremely rapid, out-of-control inflation, typically defined as prices rising more than 50% in a single month. At that rate, the value of money can meaningfully decline within a matter of days, sometimes even hours. Historical examples include Weimar Germany in the 1920s, Zimbabwe in the late 2000s, and Venezuela in the 2010s. In each case, people needed increasingly enormous amounts of currency just to buy basic necessities, sometimes literally wheelbarrows of cash for a loaf of bread. Hyperinflation typically results from a complete loss of confidence in a currency, often triggered by a government printing massive amounts of money, frequently to cover excessive debt, or fund spending without sufficient underlying economic production to support it. Once hyperinflation takes hold, it is extraordinarily difficult to reverse without drastic economic and political intervention. Stagflation. This is the inflation that breaks the textbook rules. Stagflation is the simultaneous occurrence of high inflation, stagnant economic growth, and high unemployment, a combination that traditional economic theory long assumed should not happen together. Normally, economists expect inflation and unemployment to move in opposite directions. High demand that drives up prices should also be creating jobs. Stagflation defies that expected relationship. Prices are rising even as the broader economy struggles and job growth stalls. The United States experienced significant stagflation during the 1970s, driven partly by oil price shocks that simultaneously increased costs across the economy while crushing economic growth. Stagflation is particularly difficult for policymakers to address because the traditional tools used to fight inflation, raising interest rates, tend to further slow economic growth, while the traditional tools used to fight stagnant growth, lowering interest rates, tend to worsen inflation. There is no clean policy solution, only trade-offs. Deflation. This is the inflation running in reverse, and it is not the good news it initially sounds like. Deflation is a sustained decrease in the general price level across an economy, the opposite of inflation. On the surface, falling prices sound appealing. Your money buys more. The reality is significantly more complicated. When prices are expected to keep falling, consumers delay purchases, waiting for even lower prices later. That delayed spending reduces demand, which pressures businesses to cut costs, often through layoffs, which reduces consumer income, further reducing spending, creating a downward spiral that can be extremely difficult to escape. Debt becomes more burdensome during deflation because the amount owed stays fixed, while wages and asset values may be falling simultaneously. Japan experienced a prolonged period of deflation and near deflation beginning in the 1990s, struggling for decades to generate sustained, healthy economic growth. Disinflation. This is the inflation that is still happening, just slowing down, which people frequently confuse with deflation. Disinflation refers to a decrease in the rate of inflation. Prices are still rising, just at a slower pace than before. This is fundamentally different from deflation, where prices are actually falling. If inflation was running at 9% last year and has slowed to 4% this year, that is disinflation. Prices are still going up. They are simply going up less aggressively than they were. Central banks generally view disinflation as a positive sign when they are actively trying to cool down an overheated economy, representing progress toward price stability without the severe economic damage that outright deflation can cause. The confusion between disinflation and deflation in casual conversation, and even in some news coverage, leads to genuine misunderstanding about what is actually happening in the broader economy at any given moment. Asset inflation. This is the inflation that shows up in your investment portfolio before it shows up in your grocery bill. Asset inflation refers to a significant increase in the prices of investment assets, stocks, real estate, art, collectibles, often occurring even when inflation in everyday consumer goods remains comparatively low or moderate. Asset inflation frequently results from low interest rates that make borrowing cheap, encouraging investment in assets rather than traditional savings accounts, combined with significant amounts of money flowing into financial markets seeking returns. The effect can create a genuinely uncomfortable disconnect, where wealthy asset owners experience significant increases in their net worth, while average consumers, who may not own significant investment assets, experience comparatively little benefit, even as housing and other asset prices become increasingly unaffordable for those trying to enter the market for the first time. Imported inflation. This is the inflation that arrives from somewhere else entirely. Imported inflation occurs when the rising cost of goods imported from other countries drives up domestic prices, often connected to currency exchange rate fluctuations. When a country's currency weakens relative to other currencies, imported goods become more expensive in that country, even if nothing about the actual production cost of those goods changed at all. Countries that rely heavily on imported oil, food, or manufactured goods are particularly exposed to imported inflation, since price shocks originating in completely different economies can directly impact domestic cost of living, regardless of how well that country's own domestic economy is otherwise performing. Imported inflation demonstrates that inflation is never purely a domestic economic story. Global trade relationships and currency dynamics connect economies in ways that transmit price pressure across borders, often with very little warning. Monetary inflation. This is the inflation that starts with the printing press, not the checkout line. Monetary inflation refers to inflation caused specifically by an increase in the overall money supply within an economy, distinct from inflation caused by consumer spending behavior or production costs. When a central bank significantly increases the amount of money in circulation, without a corresponding increase in the actual production of goods and services, the same total amount of economic output is now being chased by more money, which tends to push prices upward over time. This connects directly to a concept sometimes summarized as too much money chasing too few goods, similar in effect to demand-pull inflation, but with a critically different underlying cause. Demand-pull inflation originates from consumer spending decisions. Monetary inflation originates specifically from the actions of central banks and monetary authorities, controlling the fundamental supply of money itself, regardless of whether consumer demand has genuinely increased or not. Every kind of inflation, 12 different mechanisms, 12 different causes, all producing the same basic outcome: your money buying less than it used to. Demand pull comes from spending. Cost push comes from production costs. Built-in feeds on itself. Core and headline measure it differently. Hyperinflation is catastrophe. Stagflation breaks the rules. Deflation runs backward. Disinflation is inflation slowing down. Asset inflation hits investments before groceries. Imported inflation arrives from somewhere else entirely. Monetary inflation starts with the money supply itself. The next time inflation makes headlines, you will not just hear a number. You will know which kind is actually happening, and exactly what that tells you about what comes next. That is the point.